Nandini Ramakrishnan, the stock markets in Europe and America hit record highs recently. Is it a reason to be happy or a reason to worry?
The record highs that we've seen over the summer in terms of the S&P 500 and the Stock 600 are quite impressive, but they're actually based on hard fundamentals, and that earnings growth in both the US and Europe have been delivering a lot more than they have been in the past few years, and that's why you see the stock market rally quite a bit. Now, unless you're invested just in the index and not looking and checking those fundamentals, there's really no reason to be scared, because if those companies you're invested in are delivering that earnings growth, then you should see price appreciation follow that. It is a time, though, when things are a bit more expensive to look a little bit more selectively, a little bit more actively at the stocks within there that are better suited to handle this part of the cycle, particularly in the US. We like financials, we like value stocks there that have a bit more to give at this point in the cycle. In Europe, we make sure we are exposed to the kinds of assets that won't be hurt by a strong euro currency and can still take advantage of a strong eurozone growth picture.
But if you had to choose between US or European equities, which one would you choose?
Between US and European equities on an index basis, we'd say European equities offer a bit more because of the strength that we see in the Eurozone consumption data. The European economy is still a bit earlier in the cycle than the US, but there are still opportunities in the US, so we don't say necessarily to reduce exposure or necessarily pull away from US. But if we had to choose, because of valuations, the US stock market is a bit more expensive, nearly 18 times price to earnings, whereas the MSCI Europe index is around 15, does look a bit more attractive on an index level.
You mentioned earlier that there's no reason to worry, but we have the Federal Reserve that just started to reduce its balance sheet. Couldn't this lack of liquidity in the markets cause a big correction?
Certainly, the big issue for investors, especially the multi-asset space, is figuring out how central bank action is going to affect the bond market. It's one of the biggest reasons we're overweight generally on stocks. We prefer stocks versus bonds. And the big reason is sovereign bonds like the US Treasuries and Eurozone sovereign bonds are going to be challenged by the ECB and the Fed reducing their quantitative easing and their balance sheets. So that certainly can cause a lot of volatility in fixed income markets and will be one of the reasons we do not particularly love those asset classes. We should see yields rising in both the US and in the European space because the Fed is doing what they haven't done in 8-10 years, and that's reducing the amount of support on their balance sheet that they're giving to the economy.
We already talked about the Fed, but what is the ECB doing? Where aren't they following?
Because the European economy is still a few years or certainly a few stages before the US economy in terms of economic cycles, the ECB is actually quite positive in the fact that you've seen positive growth, 2% growth year on year in the Eurozone, inflation getting closer to the 2% target. When you look at retail sales and industrial production, unemployment, all of these figures are looking really strong for the Eurozone, and that's a great sign for Mario Draghi at the ECB, now saying we expect him in the October meeting to discuss reduction of the QE purchases. Right now they're purchasing 60 billion euros per month. We expect in the start of 2018 for them to reduce down to zero towards the end of 2018. So is this going to affect markets? Certainly. There's going to be less liquidity, perhaps less credit, less money flowing around, but it's not drastic in that the balance sheet has been increased so much over the past 8 years that this is just a small tapering of that to get to a place where it's appropriate for the Eurozone economy because growth is actually so good.
Yeah, but last month the Bank for International Settlements warned that the world had become so used to this cheap credit that higher interest rate could derail the global economic recovery. So what I heard, you don't share this opinion.
It's not necessarily not sharing the opinion. It is one of the biggest concerns. When we look at what on the horizon could drag down markets and really cause volatility and perhaps falls, bear markets in stocks around the world, it would be a recession, particularly in the US. And what are the things that will cause a recession in the US is higher interest rates, because companies won't be able to pay their financial obligations, as well as increasing wage growth, because paying employees is a large part of the corporate operating costs. So given that, when we look at what are the big issues at play, of course, higher interest rates is going to be a big challenge. It's not something, though, that the Fed, or definitely not the ECB, are raising interest rates at a very fast pace. So we still do believe that we have around 2 more years left in this cycle, especially in the US, because that will certainly be the first economy that starts sensing a bit of weakness. So yes, the big challenges are increased credit costs for corporates and even consumers around the world, but it's not something that affects our market view in a negative way in the next 12 to 18 months.
We already talked about the central banks, but what do you think will be the big drivers in the market for the next couple of months besides the central banks?
Well, as we've seen over the summer and actually over this year, particularly in Europe, politics has been a big play in terms of elections. A lot was on the table in terms of Brexit, particularly in the UK. Of course, we had German and French elections over the course of the year. So politics is going to be certainly a cause of volatility and driver in markets. But we do remind investors to look at the fundamentals. So earnings growth of specific companies and specific sectors that can still take advantage of the global growth picture, right? PMIs, purchasing managers indices for global, emerging, and DM space have been at the highest levels they've been in the past 2 years. That's got to translate into earnings growth, and we think that companies across the world can continue to deliver that, and that's going to be driving markets throughout the course of 2017 and into 2018.
Nandini Ramakrishnan, thank you very much.